following is a paid commercial program paid for by McClure Capital Wealth Management Companies and does not reflect the opinions or advice of KRLD or CBS Radio.
Welcome to the Common Sense Investing, or CSI Show, with Victor McClure and Guy Allard from McClure Capital Wealth Management Companies. For the next hour, Victor and Guy will use their combined 60-plus years of experience to answer your financial questions with their own brand of plain-spoken language and hard-hitting style.
Welcome back to the Common Sense Investing Show. I'm Victor McClure. My co-host, Guy Allard. How you doing, Guy?
Pretty good. Great weather. It's getting hot in Texas.
Since I'm only 32, it must be you have 50 years experience, and I have like 3 or something, right?
That's exactly right.
No, we both have 30-plus years experience each. Oh, yeah. I always like that. You'll see a company, and we have a combined experience of 100 years, and there's 20 of them.
Well, if you look at it, if you want to talk about it for a second, you look at any advisor, and you kind of look at their evolution, right? Since they usually 30 years into their career, they're not doing the same thing they did when they started, right?
Right.
In my case, started out in venture capital, and you move on, and you do things, and you do manage money, and then you kind of settle into a rhythm, and you figure things out. So you want that advisor that's already figured things out on other people's money, right? You don't want them figuring it out on yours.
I was an option trader in the 80s.
Absolutely.
Option trading is interesting. It's, to me, it's more gambling. I know there's strategies that make it a little more safer, but
strangles, butterfly spreads,
calendar spreads.
Yeah.
Everything. I just, I can't do it. Butterfly spreads, everything else.
That's right.
So I understand that kind of stuff. It just wasn't for me. To me, there was more risk in it than there were advertising. It wasn't as just, oh my gosh, it's so easy to make 2-3% a month. Really?
And there's always a good story. So if you're listening and you've got somebody that's you're listening to or looking at maybe buying a trading program, just know that they all sound good. They're all most, the good ones, they're all back tested, and they may in fact work well for a while. But none of them last indefinitely. So whether you're in the market the way you should be with your portfolio, diverse, and you've got the right amount for income and the right amount for stocks, or whether you're in a trading program, at some point you've got to know when to take some money off the table, because nothing lasts forever.
Well, think about all these. Remember, this is called the Common Sense Investing Show. If you put a common sense test to things, sometimes it'll open your eyes a little bit. It's like that. Remember that? What was his name? Norman Boo, or you'd show him with like 10 bikini girls on a yacht.
Oh yeah, Florida real estate or something. Yeah.
Those guys usually didn't get rich in real estate. They got rich telling people how to do real estate, buying their classes, doing all that kind of stuff.
Didn't the Wolf of Wall Street, at the end of the movie, you saw him doing that, right? He was selling programs, teaching people how to sell.
The bigger the pitch, the more I don't believe it.
Well, and the problem is for listeners and for us, you get greedy. They're kind of intoxicating. They certainly have sex appeal. It's not like a 3 or 4% guaranteed investment. I mean, you've got an opportunity to get 30 or 40%. Oh my, we did it last year.
We don't try to pick the market direction. If it goes up, we make a ton of money. If it goes down, we make just as much money.
That's right. My clients were out in 2008 before the market crashed. You can be too.
Everything is this and that. I'm like, okay, all right. Remember, just think common sense.
That's right.
Think common sense. Anybody tells you that you can safely make, without any risk, it's guaranteed 10, 15, 18% a year, whatever. Even if it's not guaranteed, they'll say yes, but it's, oh my gosh, it works 9 out of 10 times. You know it's BS.
And I know that this is not our show today, but also if they tell you to get out of your IRA and invest in whatever they're selling, run.
First thing they do is tell you to get out of an IRA. You better run. Close out your 401k. It's not really your money. Pay the taxes now. Be done with it. You'll be better off. We'll get all that tax money back in a few months. You're talking to a crook. Yeah. Or they're ignorant enough to believe it and don't really understand broadly how an investment portfolio should be constructed. They're so tunnel visioned into one particular thing. And don't get me wrong, we own real estate. I own rental properties. I love real estate.
And we've done pretty well last few years in real estate in Texas.
There's nothing wrong with real estate.
80s,
but
not
anybody
so much.
tells you to put all your money in it and you're going to make this fortune and close out your IRAs. I heard a show on this station telling them they couldn't get their 401k because she was only 57. He goes, well, can you quit your job? So tell you to quit your job,
I
cash
know.
out 401ks, take 50 cents on the dollar because it wasn't your money in the first place. That's not advice. That is a salesman, a high-pressure salesman. And even if they might have a decent program or a decent, how to buy real estate or get rental properties, that means nothing. They're a shuckster in my mind at this point.
And if you can gather anything from this rant, it would be this. The people that fall for that, aside from the greed aspect, are usually people that don't know how much money they need in retirement, how much their expenses are. They haven't sat down and they don't have a plan that's working for them. So if you can take a step or two in that direction, it'll pay you in spades. And if we can help, we've got programs that'll show you how much money you need based on how much income you want and make it very simple for you.
Yeah, just don't. I mean, I have very smart people. It's not just greed. It's very smart people that have said, I know I can make 3 or 4% in option trading every month.
Oh, yeah.
I know it. I know it. I said, well, how many years of history do you have in that? And they might even say a few years. And I'm like, I was an option trader for a lot of years. I've been monitoring this stuff for a long time. If somebody made 3% a month and could confirm that, they'd be the biggest wealth manager on the planet.
We saw.
There's no other bigger manager. They would be. You don't understand. Just the $500 you pay for some program or the option trading is nothing compared to the value Wall Street would place on a manager like that. I mean, they would give them billions of dollars, and they get 1% of that a year, which some of those hedge fund managers, in the old days, some of their quarterly bonuses were hundreds of millions of dollars.
Crazy money.
And they never made 36% a year, 48% a year. Yet, someone trying to sell me some program, I need to come to some seminar, has done it, and it's easy. It's so easy to make 48% a year, 4% a month.
And we started talking about experience and having 30 years each. All of this comes from experience. Victor and I worked side by side with a great commodities trader, had a mechanical program at Dillon Gage back in the, mid-90s, Victor? Mm-hmm. And I forget the numbers. It was like 100% a year return for 6 or 7 years. But eventually the market showed it something it hadn't seen, and it didn't work.
Oh, yeah. I remember another one said diversification. We believe in concentration.
Diversification, they called it. Yeah, that's right.
So in other words, we only concentrate on 5 or 6 of the greatest companies until it went broke, of course.
Yeah.
Yep. Remember, put common sense, put your hat on. The more crazy the claim, the more it should be suspect, not the more you should be interested. But that's what people do. Yep. It's human nature. Wait a minute, this guy can make how much? Now they're interested. If he'd have told you I've made 3% a year for the last 10 years, you'd say, why is he on the radio? But remember, that's what it is.
And our number is 972-715-2424. That's 972-715-2424. If you want to know how much money you need to have in retirement so that you could get X amount a month in income, it's easy for us to figure, and it'll help you plan for the future.
We are the Mythbusters here. If you have an investment that you think passes the bulletproof, the smell test, whatever you want to say, and you say, here's what we got. Now, shoot a hole in it for me. Tell me why this could be dangerous to me or whatever. When it's done this, this, and this. And the guy said he's been in business for 50 years, blah, blah, blah. I have no idea if an investment's going to work or not. All I know is if the claims are ridiculous, usually the investment doesn't work.
I had a client on the phone just yesterday, helping her getting her RMDs. We had the company on the phone, and we asked, what's the current rate that you're paying? And it was frozen at 4%. She's had the account for a long time. And she asked me on the phone. We were on a conference call. She goes, guys, should we sell it? Should we change it? I said, no, that's a home run. It's 4%. It's your RMDs. You let it stay. So the point being, if you have something that is good and it's safe and it's doing what you want it to do, we absolutely will tell you that, and we have a reputation for doing so.
I had a client come in with, they had some old fixed annuities.
Right.
All right. Now, I was the third guy that they came to.
Right.
Now, first off, I was a little offended that I was the third guy they came to, but
that usually works out, though.
It does work out. But the third guy they came to, and they said all 3 of them said I need to exchange this annuity. So I looked it up and said, I have no idea. Let me look at it. It didn't take long.
Right.
That annuity he bought had like a 5% minimum, a 4.5% minimum.
Guaranteed.
Yeah, guaranteed.
It was
That's
an old
the
one?
worst they could ever do to you.
Yeah. Oof.
And I was like, wait a minute. It's 100% liquid. You never have no penalties. That stuff was gone a long time ago, right? But it's paying you 4 or 5%. Worst case till you die. I go, why would you ever get rid of that?
Is it a single premium or a flex? Can I add money to it?
Yeah, that's what I told him. He goes, no, I already tried.
So it's a single premium.
But anybody that's another smell test thing. If an advisor tells you to get something that's obvious, because look, our back testing has showed that we could make 7, 8. That ain't a guaranteed 4 or 5. In today's fixed income world, that is fantastic. There's no interest rate risk, anything. So make sure you use common sense for everything. We do that for our investing, for our strategies we use, everything. Don't hesitate to call us at 972-715-2424. You can see our new offices here at the Star, the home of the Dallas Cowboys. Again, 972-715-2424. You can go to ilovemyretirement.com. Stay with us, folks. You're listening to the Common Sense Investing Show on News Radio 1080 KRLD.
Welcome to the Common Sense Investing Show, where your investment strategy is always based on facts instead of some sales pitch. Here's Victor McClure and Guy Allard.
Welcome to the show. Welcome back to the show, right?
Welcome back.
Let's talk a little bit about Harry Dent. He's considered the contrarian's contrarian.
Not my favorite economist, but go ahead.
You know what a contrarian is. When everybody thinks something's going up, they think it's going down. In the 80s, the market wasn't too good. He said that's going to be a 20-year bull market. So he was actually they call him the perma bull. He said it was going to be bullish, blah, blah, blah. But right before that, basically, he predicted the 89 economic collapse of Japan. I remember I was starting out in business.
I predicted that economic collapse of Japan.
Well, think about it.
Deflation and all.
They were buying up California.
Have you read my book?
Yeah. I was sitting there going, I think I need to go take some Japanese classes.
Yeah, there was a big...
I won't be able to function in business without knowing Japanese.
Remember in the early 80s, Kuwait and all them were buying all the real estate here, too, and there's a big deal about them having too much real estate.
He also predicted the 2000 dot-com bust and the 2006-2007 housing bust. It actually started in, 2008. But he said that so he's a little bit off on that one, but pretty good. But his principal argument now is, he says, the stock market, the economy, and real estate, in his words, will go to hell in a handbasket within 3 years.
He's predicting one of the largest crashes of our lifetimes.
He said some detractors are saying he's too simplistic. He uses demographic changes and spending. If you're going to be simplistic, I think that's what you should, because spending is, 70% of our economy? And so as spending goes down, so his major argument is baby boomers are coming to the point. Like right now, they're the big earners. They make the, in your 50s, usually, up in the 60s, you make the most money in your career typically, and you spend the most money typically. They're spending a lot. Well, they're starting to get to the age where they retire and die. And when they die, the next generation that's replacing them is a lot smaller. So he said it's going to be a tax on health care, consumer goods. People are going to buy a lot less of them just because there's less people. All of those different things. But now he's adding other things into it. But here's what Harry said to Think Advisor. If we don't see a major financial crisis in the next 3 years, I'll give up and become a limo driver on the Gold Coast of Australia. He goes, it says, why are you so sure there's a meltdown? He said, we're bubbling up. My goal is to get people to avoid the next few years. If you get out of the market early and miss the last 10, 20% into late July or longer, it won't matter compared to how fast this bubble collapses and goes down. Every day the risk goes up for investors. He's talking about advisors must help their clients avoid what he calls a once-in-a-lifetime reset, similar to the Great Depression he sees en route.
And how do you do that without being panicky, without scaring our listeners? You do that by having a plan, by having the right allocations in each plan so you don't have to worry about it. If the income's taken care of, if your inflation part is taken care of, you don't have to be a pendulum and go from all in the market and all out of the market and worry about this stuff. I compare these guys, and a lot of good points there for sure. But, if you're a football fan and you watch Bradshaw and Jimmy Johnson and some of the greatest minds in football and all they do all week long is talk to the players and who's injured and who's coaching, and they know that game better than anybody. But you watch at the end of the show, when they pick who's going to win and who's going to lose, they don't do very well. And it's the same thing with an economics guy. They know all the stuff and all the rules and all of that. But inevitably, like we were talking about in the first segment of the show, my opinion, when you've got these managed programs that are back-tested years and it works, so it should work forward, all that stuff's accurate until something new happens, a new deal. Maybe
There's always something new.
There's always something different. But the point for me I take out of this is have your allocations, know what you need and plan for it.
I like having my powder dry. Have some cash. If the market does collapse, there's some great buying opportunities in there. I tell you, I'll give you an example. Just in my neighborhood, I looked it up on Zillow the other day.
Right.
One of my neighbors, I'm not going to say which one, obviously. But
oh, go ahead.
They bought the house out of foreclosure. It was like $338,000. 2011, I think, 2012. What do you think it's worth today? $980,000.
Oh, I never got those deals.
But that's what happens.
Yeah.
Is there are deals like that.
But what can happen in 5 years? It can be worth $500 in 5 years if something like the 80s happened. You just don't know.
But that's why, like I said, I like keeping my powder dry for opportunities because the stock market over long term does go up. Anybody that says it doesn't, not really telling the truth. It does go up. The last time it went up, it took 5-6 years to come back to a new high, but it always goes up. If you look at it over 10 decades and things like it goes up.
Hence, the younger you
because
are.
Prices go up, Nobody's going to lower their prices every day. Prices go up. It said, they asked him, what's different about the bubble that you perceive? Well, most bubbles have strong fundamentals behind them because a lot of people are saying, well, the earnings look good. He goes, this bubble since 2009 has been 100% generated by artificial stimulus. He said, this stock market is completely from in other words, keeping the Fed funds rate at zero, keeping borrowing costs to nothing. All of those things have fueled this entire thing. And he said let's see what it said. Why don't we have another global financial crisis? He said, we didn't really deal with the real problem in the first place. We didn't deleverage debt. We added more debt, especially in the emerging world, which is less stable. Why will the meltdown be even worse this time? Because this is a once-in-a-lifetime reset that will be happening in the next 3 years. It'll be like 1929 to 1932. The bubble of real estate, commodities, stocks are largely reset. If you can help people avoid that reset, it's going to make a substantial difference in your wealth and well-being in the future.
And if you need help, if it's confusing, if this frustrates you, call us, 972-715-2424. We can help you through the landmines.
Stay with us, folks. We got a break coming up. You're listening to the Common Sense Investing Show on News Radio 1080, KRLD.
Welcome back to the Common Sense Investing Show, hosted by two of the most experienced advisors in the DFW Metroplex, Victor McClure and Guy Allard.
Whoa, welcome back. We're talking about Harry Dent. Did an interview for Advisor magazine here, and our Think Advisor. And I was pulling some stuff from it. It was interesting. They said, but hasn't the election of Donald Trump helped the market? It says the Trump rally has nothing going for it except hope that he's going to wave a magic wand and create 3 or 4% growth again in the U.S. And he said that's irrational. He says, they said, do you take China into account as part of your theory? He goes, yes. When this thing blows, it's going to blow hard. There's no chance in hell, this is his words, that China will have a soft landing when the stock market crashes. It will send a tsunami around the world in real estate prices where Chinese buy, like California, UK, Toronto, Australia. There are a lot of real estate bubbles around the world. What's the biggest threat to the market this year?
Didn't say Dallas.
So the ultimate biggest threat is the collapse of China because it's the biggest bubble. China's a train wreck. There isn't a central bank in the world that has a strategy that can offset that earthquake. It's not like Greece being bailed out by Germany and the EU. It's gigantic. It's the second biggest economy on the planet. If it crashes, it is felt all throughout the world. All right. Said, what investment strategy you recommend for people right now? He said, long-term trends are simple. Short-term trends are complicated. But in the short term, get into safer investments. And he tells you some ideas of, AAA corporate bonds, short-term, stuff like that. He said, what about traditional buy and hold? Because it's worked really good for 8 years. Buy and hold has been dead since 2000. I don't know about that, but if you buy and hold, you're going to be crucified worse than you did in 2008 to 2009. Buy and hold is the riskiest because people tend to make money most of the time. So you'll make higher returns, but when you're wrong, you'll have higher losses. People don't know how to play volatility. Said you sound bearish. In contrast, in years you were bullish. You seem to go to extremes. I used to be a perma bull. As soon as we get the first demographic indicators in 88, 89, I was the most bullish guy. I said there's going to be the greatest boom in history and would last all the way to at least to 2007. People thought I was nuts. But even then, it would end after 2007 and things were going to change. So that's just one. I've seen several. But I've seen few of them that say, no, it's going to never go down. It's going to keep going up forever. All I know is that I put a common sense litmus test to everything.
There you go.
Nothing goes up forever.
That's right.
But it's hard. It is hard to change anything if you're making money. It's hard to reallocate something when you're making money with it. You know, I have a lot of people in my office think the market's going to go up forever. I have just as many think I'm not touching the market because there's no way it's not going to crash.
Well, and you were telling me the other day you were talking to one of your buddies that had a couple $1 million in their retirement account and asked him if he felt any inclination, didn't you, that whether he should take some and protect it or, make any changes, readjust it. And what did he tell you?
Oh, no, not right now.
No, not going to do a thing.
And that's normal. That's what everybody's doing. It's made too much.
Right.
I looked at one of my retirement accounts. It was actually 2 days ago. I was like, whoa, that thing jumped quite a bit.
Yeah.
That's what everybody's doing. It's just the way it is. But remember, you have to do something. You have to look sometimes. You have to say, hey, this can't last forever. I got to be careful here. Take some off the table. It's just like going with house money when you're in Vegas. You just don't keep letting it ride on that one number you got lucky hit or whatever. You pull some off. So no matter what happens, I still make a profit. I'm playing on house money, whatever you're going to call it.
And if you're our age, if you're in your 50s, if you're in your 60s, you've seen it happen twice this century. You've seen it happen in 2000. You've seen it happen in 08. Whether it's 07 or 06 right now, we don't know. But what we do know is the market will correct. We don't know how much or when. But again, at the risk of being redundant, if you have a plan, if you stick with it and you stay the course, you'll be fine.
There was a poll or a survey put out for investors, like, people within a few years to retirement or whatever.
Right.
And they did a quiz to ask them if they're going to be retirement ready. What do they know? Well, 74% of them failed the quiz. Right? 13% of them got a D. Now, wait a minute. A D is failing in my world, right?
Yeah, it's not good.
That's 87%.
So we got 13 left.
8% got a C. 5% got a B. How much do we got left? Fewer than 1% got an A on this retirement readiness test.
How many
the
questions?
average score was 47%.
70 questions? How in-depth it was?
38 questions.
That's not bad.
No, it's not bad. I made 100 on it. And I'm not bragging. This is my business, right? Guy, if he took it, would make 100 on it. But that's the kind of stuff you need to know. There's certain things in there that everybody should know. Because if you're about to go to retirement, you're in that red zone, that 5 or 10 years before retirement. Or in retirement's worse. But all of these people failed this quiz, and these are basic information about retirement income planning, Social Security, and Medicare.
And not to make light of it, but if you want to make 100% on your retirement quiz, call us, 972-715-2424. That's 972-715-2424. Visit our website, ilovemyretirement.com.
Well, stay with us, folks. We got a break coming up. You're listening to the Common Sense Investing Show on News Radio 1080 KRLD.
Welcome to the Common Sense Investing Show, the home of plain-spoken, no-nonsense answers to your financial questions.
Welcome back to the show. All right, we're talking about the American College.
Yes, sir.
It's up in Burnmar, Pennsylvania. Did a study for retirees, pre-retirees, and they gave them a quiz on. It's basically on retirement income. How much should the person take out safely and still,
good
last.
Stuff. Good stuff.
Medicare questions, Social Security questions. What's the difference between A and B and C if you take Social Security at different ages? What's the real difference and all that stuff? So they did all that, and only 1% passed. That's
You know, I was thinking about that during the break. It would be like you and I taking a quiz on heating and air conditioning for your home. Not that we couldn't learn it and do the
Right.
field, but we don't do it. We would fail it because this is just something we do day in and day out.
Oh.
Just like the heating and air guys know that like the back of their hand because they do it every day.
I forgot. 14% passed. 1% got an A.
That was crazy.
14%. So 86% of people failed this quiz.
And if you got a C, your retirement's not going to be that
No,
great.
like I said, this is what we do. I took the quiz as quick as I could read the questions. I got 100% because this is what we do.
Yep.
There's a lot of things. It's amazing to me. Certain occupations are worse than others. But they think since they've done something, like I've invested in the stock market for 20, 30 years, I know everything it is about the stock market. I know more than everybody, all the advisors and everything.
I don't want you performing heart
That's right.
surgery on me.
I've never taken Social Security, but I know that this is the best way to take Social Security.
That's right.
Think about it. If somebody's done something 1,000 times, you've done it none or once. That there's perspective alone is worth it. There's things that you don't know that you don't know.
That's exactly right.
And that's what we're always talking about here. That's why I think at some level, even if I was a self-managing person, I'd always have a financial professional, at least for a part of my money. Because if something happens to me, my wife is not equipped. Don't get me wrong, she's smart enough. But she has zero experience and she doesn't want to know about finance and things like that. All right. We developed this show to answer your financial questions. Anytime we get a few questions I think is going to appeal to a broad audience, I'm going to share it with you. So, Guy, what's my first question?
All right. First question is, I have a private REIT, which is an acronym for Real Estate Investment Trust, that's been in business for 40 years and pays me 10% per year and part of the profit if they sell the property. 10% per year and part of the profit if they sell the property. I know you don't like private investments, but this one sounds pretty good, right?
It does sound pretty good. There's nothing wrong with a private investment can make money if real estate's going up. Right now, like I said, my house in Prosper has supposedly gone up like 10% a year or something, or 15% a year, some crazy number.
Right.
As long as that's happening, everybody's making money. And pretty much you can do a lot to real estate and make money if it's doing like that. I always look at, as long as it's a small percentage of your money, no harm, no foul. And you're diversifying into a sector that you should be in.
Right.
I truly believe everybody should have real estate as part of a sector. But you also got to put the common sense smell test to it. Think about this. You're this developer, and you're bringing in investors, right? You're going to pay them 10% a year plus 10% of the profit. Now, you've been doing this 40 years as a developer, right? That's right. I have a solid reputation. I've been the best developer in Dallas. All right. So if you're doing that, why are you paying people 10%? Why don't you go to the bank and get a loan for 4%? Think
Risk.
about that for a second.
There's risk.
There's risk in it. Otherwise, anytime somebody tells you, normally I don't let people into these deals. This is just because I like you. I think we've become friends, and I'm going to put you in this real estate deal that I wouldn't normally. That was usually because I know a lot of real estate guys, but that would be the kiss of death. Anytime they're trying to let you in on there's something going on in here. I know a very close friend of mine that they
story.
A big real estate deal. This guy, rich real estate guy, you don't understand. They're Victor, they're rich. Had to let him into this one deal because they knew him from high school. Well, after being in the deal for years because they wouldn't let me read it, later on found out they're paying like 50, 60% of the carry in this thing, taxes and insurance and everything.
Yep.
They own about 1%.
Difference between working interest and net revenue interest.
But that's not saying it won't work. Some of this stuff if you're doing real estate in a hot real estate market, pretty much everything works. But when it turns, that's the problem. Remember, if I'm a developer, I'm getting a loan from the bank a whole lot cheaper than 10%. I don't have to give up any of my profits if I sell the thing. And so that's usually some of the things. Now, there's other things involved. Sometimes, banks are a pain in the you-know-what and all that kind of stuff. But that just doesn't pass the smell test. I heard this one, New York real estate, 10% a year, every year. It's guaranteed. Of course it's guaranteed as long as there's no vacancies. as long as real estate doesn't crash and vacancies don't increase, as long as values don't go down. You can't refinance out of something that's going down in value, right? You can when it's going up in value. You get in a little trouble, you can refinance out, take a little equity. You can't do it when it's going down.
One of the problems we've addressed before on private REITs, not a public REIT, is you have to have a market to sell something. You've got market makers, stocks. There's always a market to sell your stocks. Pink sheets, not so much. The penny stocks, there's no market for it. Private REITs don't have a market, and it's very difficult for them to make the transition from being a private REIT to going public where there's a market. Why do you need a market? Well, if you want to cash out, you have to have a market, someone to sell to.
And they always tell, every salesman ever said to you, we have create a secondary market. When something's going down,
good luck.
You bet your ass you ain't getting out of it. Period. All right, so that's what. We're just picking on private. Any kind of private investment, they can. Let's say they manage a property, which they always do. They could double the management cost. We're not making enough profit over here. We're going to double the cost. There's no law against that. It's private. I can do anything I want to you.
I've already disclosed it.
That's
in
right.
The prospectus.
And you are an accredited investor because you signed right here that you are, which means you're considered savvy. And anything I do, you have to take ownership of it because you're accredited.
That's right.
So I'm not saying that you shouldn't do them or whatever. It's just there's risks there. Don't anybody let you tell there's not. We got a break coming up. Don't hesitate to call us if you have any questions. 972-715-2424. Stay with us, folks. You're listening to the Common Sense Investing Show on News Radio 1080 KRLD.
Welcome back to the Common Sense Investing Show, hosted by two of the most experienced advisors in the DFW Metroplex, Victor McClure and Guy Allard.
Welcome back to the oldest advisor.
Well, I'm listening to that as it brings us in. It says two of the most experienced. It doesn't say two of the smartest. Can we change that? Who do I need to talk to?
We're answering your financial questions. Do we have another question, guys?
Imagine we can find a couple here. All right. Why do brokers always pitch money management when everyone knows buy and hold strategies are better? In other words, shouldn't I put all my money at Vanguard and forget about it?
I guess you'd like me to say, well, they make money if you do the money management strategies. They don't if you do Vanguard. I'm sure that's what they think. Well, it just depends on what time you're talking about. I'm telling you right now, if the market crashes tomorrow, buy and hold will work pretty good afterwards. If you can withstand, market's gone down 50% twice in the last 17 years. If that doesn't bother you because you know long-term it'll come back, I agree with buy and hold completely. If you're a person, let's say you're within a few years to retirement or anything like that, and we've already had 8 up years in a row, which there's never been a 9 in history, right? All of those kind of things, well, that might mean managed money might be a better. Now remember, that's strategic is also called indexing, strategic, buy and hold. Tactical would be trying to take advantage of different economic situations that are occurring. Right now, after the market's gone up 8 years in a row, I don't think buy and hold is going to be most effective for the next 5 years. But if it goes down, it's just like when you're buying my neighbor's house for $300,000, it's worth $1 million now. I like buy and hold after it's dropped, and I'm not a type of person. It's just, and also depends on your personality. I can't watch my money go down in half. I cannot do it.
It's painful, right?
Yeah, it kills me. So if I have something that will protect me from that, even if sometimes a buy and hold strategy might in the end game make a point or two more, I'm okay with not, as long as I don't take those big down years.
And I would add, I think the Vanguard, and I use that for a lot of friends, clients, and clients' kids that are just starting out, is a good kind of autopilot thing, right? Because you go in the S&P 500, probably through ETFs. VOO is the symbol for it at Vanguard. Very low fees. You get the dividends, the whole 9 yards. If you're looking at money managers, and we go through lots of processes here, their tenure, how long, what's their track record, what do they do, but something easy for you to do if you're looking at a managed account, just compare how long they've been in business, what their returns are, compared to what the S&P 500's done. I mean, it's a simple thing for you to do, but it's a place to start if you're shopping.
See, to me, I'm willing to give up a little bit on the upside to protect the downside.
There you go.
But a lot of people aren't like that. So if you're looking for a purist return, very long term, I probably agree with the buy and hold strategy in theory. I do. If you're, I recommend nothing else to a 30-year-old. But as you get older, things change. Your situation changes, and the economic conditions change. Like 8 years into a bull market, if you did that, just take every bull market we've ever had, invest right at say 5 years into the bull market. Your returns are about 1/10 of what the actual market returns are, because you're coming in at the end.
And that's why you change it the older you get, right? You don't have that long time value of money to recover. The older you get, the less you have in the market.
I mean, our managed program at Fidelity is basically, it's in every sector of the market. Any sector goes below its moving average, automatically out of that sector.
Comes out of it.
Now, sometimes that's not going to perform as well as something else. Here's why. Because we might have different weightings of the different sectors based on how volatile they are or whatever. And so, because what happened is you could have the technology sector of the S&P make so much that it overshadows everything else.
Absolutely.
But we might have a different percentage in there, higher or lower, which would cause us to make more or less. So it's not going to be exact on the upside, but I'm telling you, it's capturing a lot of it. But I think the lowest it ever had is a down year, 7%.
And as that technical goes up, it adjusts.
Oh, absolutely.
As it starts coming down, it adjusts. It's not perfect.
My logical brain says protection, since mathematically, if you lose 50%, it takes 100% gain to break even, is worth more. Now, when you're 8 years into the market not going down, I'm being proven wrong as far as return goes, right? As soon as it goes down, I'm right again.
Yeah.
I was wrong from 2000 to 2007, but I was right again for all the way until it come back. That's why a combination of things sometimes, where you're always going to be right one way or the other. You're always right on this side and this side, and long term you're in the market more than you're not.
Always,
I think it's going to work out better.
When you're always right. That's a great statement.
All right, what's the next question?
All right. I have several IRAs and a couple of old 401ks. Do I have to figure RMD for each one, or can I put them together?
RMD is required minimum distribution. Also, you'll see some statements call it MRD, minimum required distribution. That is when you're 70 and a half, they make you take your money out of retirement accounts. The only exception is if you're still working for a company, you don't have to take an RMD out of a 401k.
Correct.
Everything else you have to. Now, you can combine different retirement accounts if they're styled exactly the same. In other words, they're IRAs. IRAs, you can add all of them together and take it all out of one. But if you have an old 401k that was never converted to an IRA, that has a separate RMD. You cannot add the value of that one with your IRAs and take a combined one out. You could get penalized for that. And not taking the correct RMD is a 50% penalty, not 15.
No.
50.
It's painful.
So make sure, if you have any RMD questions, don't hesitate to call us, 972-715-2424. Again, 972-715-2424. I want to thank everybody for listening today. Don't hesitate to go to our website at ilovemyretirement.com. I'm Victor McClure. For Guy Allert, we always appreciate your time.
The preceding show is paid for by McClure Capital and is for informational purposes only and not a solicitation or representation of any particular investment, product, or service. Any views and opinions do not constitute financial, legal, or tax advice. Consult with your appropriate professionals before making any investment or savings decisions. Always consider your risk tolerance, time horizon, and objectives in making any financial decisions. There is never any guarantee of future success or performance.
The preceding was a paid commercial program paid for by McClure Capital Wealth Management Companies and does not reflect the opinions or advice of KRLD or CBS Radio.